It was a seesaw day for stocks as a mixed bag of economic and earnings data cooled some of the enthusiasm. Not much that's fueled Wall Street's summer of fun.
Yeah, but still, some late-day buying helped us finish on the plus side for the fourth session in a row. And the Dow is up, listen to this, more than 40% since the lows of March.
But our next guest says the rally would be even better if it weren't for government fiscal policies.
He is Rafael Resendes, co-founder of the Applied Finance Group. Good to see you again, Rafael.
Good to be back. How are you guys?
We're fine. So do you think that the government is kind of retarding a recovery that would have been even more robust?
Yeah, you know, it's not just what I think. It's we actually did a survey of hundreds of investment managers that we post every month on our blog at valueexpectations.com. And what they came back with was very interesting. 80% felt the economy is going to grow in the next year, but roughly that same number felt the economy is on the wrong track. So as we kind of dug down into some of the comments that people were making as they answered the question, one theme kind of continued to repeat itself over and over, and that is people are very worried about fiscal policy that's coming out of Washington these days. We see by an overwhelming 9-to-1 majority, money managers are against what's happening with respect to any notion of a second stimulus. 9-to-1, they're against cap and trade. And the foundation for this is pretty clear. If you go back and you look at Wall Street and Main Street, when government has a heavy hand in what's going on, everybody suffers. From 68 to 80, real returns to the stock market were negative. GDP growth was about 1.5 points below the long-term average to the United States.
Rafael, I hear what you're saying because I've talked to a lot of very smart people who feel that we built a really shiny new building on a still cracked foundation instead of just letting real failures fail. But how do you square that with the fact that we have seen a cut in half of the number of job losses? We were losing close to 700,000 jobs a month at the sort of height of the crisis, and now we're down to still losing. It's horrible, but you know, about 300 to 400,000. So help us square these numbers away with some positive sort of salubrious effects in the wake of government programs that actually started during the Bush administration as well. So you could credit both parties with it.
Sure. I'm not necessarily thinking that this results back to government policies. I think it's really kind of a testament to the wonder of the market. You know, as the market's adapted to a new economic environment, we're seeing changes in the way businesses operate. We're seeing changes in consumer behavior. Consumer spending in the United States is up, more positive than it's been in the last decade. Everybody's starting to change their behavior, and that then starts to trickle into a new reality that the market adjusts to. And even though jobs are still being pared down, we're going to eventually see this turn as the market adapts and innovation starts to take hold. We're going to see the economy turn around. The sad thing is the opportunity loss that we're going to have. Higher taxes, higher inflation lead to slower economic growth, lead to slower market returns. Wall Street and Main Street ultimately are linked together. When Wall Street does well, Main Street does well. The economy is growing and people have jobs and people are prospering. When you have policies that make capital harder to invest or more costly to invest, everybody pays the price.